Hi there, everyone, and welcome to this month's edition of On Track. Rob McGregor here, and I'm recording this on the 28th of September. And we're having a beautiful spring on the sunny coast, a bit of hot weather around the country, and I hope you guys are all doing well. We'll jump in a minute, but before I do, just to reiterate, this monthly video we do is for clients of McGregor Wealth Management, and particularly those that use our care investment process and methodology. All others welcome to listen, but please don't act on anything that you hear in this without getting advice suitable to your own circumstances. We're going to cover all the news. It's a bit of I've added down the bottom there, exciting life, boring money. We do always talk about that at the end, but the old money side's a little bit boring at the moment as we just bounce around, particularly around inflation, interest rates. Have we been inflation? Have we not? The market changes its minds every day, and we're sort of just zipping up and down in little bits at the moment. So the money really is boring at the moment. But I'm going to talk about what's going on at the latest and news at the moment. Both in we had on about the 20th of September, the Fed announcing that they were keeping rates steady, but talking tough about the need to potentially have rates higher for longer. The RBA is talking the same message. And part of that's because inflation is being stubborn. You'll see the two charts down the bottom here, both in Australia, the monthly figure that came out yesterday. And that's one of the reasons I wait till the last week of the month to get the monthly inflation figure. It's eased up a little. Now, most of that was due to rising petrol prices, which the RBA will generally look through. But yeah, it's well outside that golden the Goldilocks band that the RBA is looking for long term, which is 2 to 3%. We dropped dramatically, which is the really good news, but now we seem to be stuck, around that 5%. And we see the same in the States. They dropped beautifully as well, but then it's up a little in the last little bit. So it's the same story playing out in both, although slightly different. So that caused the share markets to ease back a little. The ASX 200 had got to about 7.4, but it's eased back around the 7,000. And what we saw causing that was the fact that 10-year bond yields jumped a bit, now about 4.5%, which tends to push share markets down. So you'll see no change to the cash rate, no real change to 90-day bank bills. They're all about just on 4%. 10-year government bond yield in Australia about 4.3. So it's snuck up a little bit in the last few months. I'll talk about that some more. Exchange rate's been a little bit weaker, but still around 64%. As I said, inflation up a little. US inflation up a little. Short-term numbers don't mean much. It's the bigger picture trend. So it's going to be interesting to watch the next few months. No real change on mortgage rates. Yeah, you can maybe shop around and get something just below 6. We're seeing most people have mortgages with a 6 in it. If you're in the above 6.5%, you should be reaching out to renegotiate or refinance. And term deposits, 4.8%. We're seeing that sort of number. That's a 1-year term deposit at 4.8%. We're also seeing that available at some of these high yield savings accounts as well. So that's the news. The portfolio returns, a quiet month, a little bit slightly negative for some parts of the portfolios of the month because the share market down. I'll talk more about that. But when we look at the portfolio returns over the long run, they continue to be pretty much on track with those targets that we have, so no major changes. 1-year returns are looking pretty good at the moment, but that's partly because we're in a dip 12 months ago. So over the last 2 years, we've had markets go down and then come back up again. So last year looks good, the year before looked bad. But in the long run, those 3-year returns are also in the long-term target range. The 5-year returns are slightly below, but only slightly below. It's certainly adequate. Consider what the market's doing, and all our returns are still in that top quartile compared to our peers. And we did saw a horror story. One of my new clients, we picked up a balanced investor who for the last 5 years had only got a 1.7% return. With our stuff, they would have had more like 5.7, which doesn't sound spectacular, but in this case, 4% under, just through sloppy management more than anything else. So, this stuff makes a big difference in terms of getting it right. As usual, we continue to be firmly in the wall of worry at the moment. It's a long time since we've had a boom back in the early 2000s, and we're certainly wall of worry. We actually have the dial right in the middle at neutral. Now, the Fed produced, you might hear this on the news, they produce a dot plot. So their dot plot is all the federal market participants, as you see here, all their assessment of where rates should be, both now but forecast. So we can see that they're all around the current rate at the moment, but then in the next year, they're spread a little bit, but consensus is a little bit of a drop in 2024, a bit more of a drop in 2025, but you'll note the broadness of the range there. So some people thinking interest rates in the US will drop back to 2.5%, and some people thinking about 5.5%, so still where it is today. Now, these are the members of the Fed who make the decisions. So you can see that committee, so all those dots are individual people, they have a wide range of beliefs as well. And one of the things I've talked a lot about in the last few months is that these are some of the smartest people around, and they still don't know what's going to happen. So just be careful about thinking just because someone says something on the news that it's going to happen. We saw this with our own governor of the Reserve Bank, where he thought rates would stay low through to 2024, and he was wrong, and he's a smart guy. We have a new governor of our Reserve Bank, and she's got these challenges to work through as well. And you can see in the longer run, of course, they all forecast that they'll be back down in that 2.5% to 3% range, but not all. There's 4 or 5 that think it's going to be sticky for a bit longer. And you can see those I've highlighted there, where that tough talking by the Fed caused the market to drop back in the US. But when you look at it over the last little period of time, it's not really that much of a drop when you look over the last sort of couple of years. So some of the other news that caused the Aussie market to be a little bit weaker, and you can see the chart there for August, and we had a peak of just over 7.4. We've run down the time recording to just over 7,000, and part of it was talk about a slowdown in China. And this is partly because of the Chinese property market. It appears they've built too much property. Some of the property companies are going broke, and that's slowing down China's growth. And whenever there's a slowdown in China growth, people worry about what that means for Australian exports. And it's true. We should be worried, but not greatly. The Chinese government will often, they don't like slow growth either. The Chinese government needs to maintain a high standard of living for their people, or they'll have rebellion. So they have way more powers than typical Australian or US or Western governments, because they can do more things. So they're likely to do stuff. And we've seen some things like iron ore prices come back a little bit at the moment, but that's what was impacting the markets during the month. But one of the things we often forget as the media throws us bad news is some of the good news. And some of that good news is things like India is fast developing. The Indian population is now bigger than China. It's crossing over right as we speak, and it's going to continue to grow. You'll see in that the top left hand, the blue line, India is bigger than China, and it's much younger. So the Indian population, the bulk of their population are in their 20s. So it looks good for Indian growth as those people age and build wealth, etc. And the Indian economy has jumped to be the 5th largest economy in the world. So the US and China are by far the 2 biggest economies in total. But when you look at the GDP per capita, US is about 80,000 per capita, and Australia is pretty similar to that per capita, but we're a much smaller economy. We're actually 13th on the list globally. And even India at 5th is 3.7, 3,700 billion. I think that's 3.7 trillion compared to 27 trillion for the US and 20 trillion for China. So what happens in the US and what happens in China make a massive difference to the world. And then you've got Japan, Germany, etc. So an interesting perspective. As much as the media throws out some bad news on stuff, there's always or often good news in parallel that doesn't get as much publicity. Looking at interest rates, and we do like to watch what happens to the yield curves, because it does influence share investing, but also the fixed income investing. So the orange dots here are where interest rates were 6 months ago. So we can see at that point, 10-year government bond yields were in the low 3s. They're now in the low 4s. So a big jump of 1% over the last 6 months. And you can see that down in the bottom 2 charts, that while it looked like those rates were steadying, they've now jumped up a little bit because inflation is sticking around for a bit longer, or that's the fears. Now, whether that comes back down Well, yeah, this is what we've seen: good news, bad news, good news, bad news on the inflation front. And I'll flick through here and here. But yeah, just to reiterate, we've got the dial in the middle. That just means we think the market is at fair value, and we've seen it just bounce up and down in the last 6 months, which I'll talk about. The single issue obsession at the moment for the market seems to be interest rates and inflation. It's the main news. Any news that thinks inflation's longer causes a bit of weakness in the market, and any news that thinks inflation's going to be shorter causes some strength in the market. Now, sometimes that good news is bad news and the bad news is good news, because if we beat inflation, it often means the economy is slowing down. So while beating inflation is good news, economy slowing is potentially bad news. So the market works all this stuff out, and in the long run, it just doesn't matter as it goes up and wobbles around. Still kept in some charts from last month around the new normal for rates. Inflation's coming down, but not quick enough. Cash rates are really back to where they were. So when we look at the bottom left-hand chart here, cash rate in Australia at 4.1%, it's back where it was in 2012, back to about 2008. So after the GFC, rates were dropped to be stimulatory, then lifted when they got the settings right, and that was around the 4% level. So as much as we're thinking that this cash rate is high, there's a potential that it's kind of a new normal for a while. And while a consensus from many is that rates will drop back into the threes for cash rate, there's no guarantee on that. Mortgage rates haven't changed much. I'll go through those at the end of this, as always. But those 10-year bonds have just stuck their heads up again. So interesting to know, are we at high? This is the debate at the moment, and it's a bit of a boring debate. I'm sorry. Are rates high, or are they just back to normal? And no one knows. So we get, sometimes we get this over precision, and that's exactly what I want to talk about in our behavioral biases section. It's overconfidence bias, and overconfidence bias is just the fact that we think we know more than we do, and we think that smart people, economists, heads of reserve banks, know more than they do in terms of their ability to forecast. As much as they're very smart people, they do their best work in forecasting, they're not that accurate. And in this article I pulled from here, I note the 3 different types of overconfidence bias, which is overestimation. That's where people are way more confident they should be on how better to judge specific numbers. And that flows into over precision, where, like in that dot plot from the Fed, they're all predicting exactly where rates are going to be month by month. There's no way they know. They're making their best estimates, but to think that that's exactly what's going to happen just because some experts say is falling victim to this overconfidence bias. And overplacement, which is where a person with overconfidence bias overrates themselves compared to others. This is a funny one. I think the stats are 60% of people think that, 70 or 80% of people think they're above average drivers, and obviously you can't have 70% of people being above average. And this one is fascinating because the smarter professions get, the worse the overconfidence. Fund managers, 80 to 90% of fund managers think they're above average. Now, you obviously can't have that. And in fact, 90% of fund managers underperform the markets. So the result is quite the opposite. But the most notable ones in studies here were academics. So some of the smartest people in the world, 90% of academics think they're above average when compared to their peers. Now, while they all might be smart, they all can't be above average. So if someone thinks they know something about the market, for them to make money out of that, they have to know something that no one else knows, and then they have to be able to act on it, not only once, but twice, when to buy, when to sell. So it's very, very hard to do, which is why we have a bias towards index investing for the majority of the portfolio, unless there's a good reason not to. Part of this overconfidence bias applies in the negative, and I'm just reiterating the switch data we got from my good friend, Dr. Mark Brimble, who sits on the Care Investment Committee, that showed that during COVID, industry super fund members did way more multiple switches than they normally would, and all at the bottom of the market. And then in the next year or so, they were putting money back in after the market had recovered. So a massive negative effect for those. They effectively sold high and sold low in panic, and then bought back in, thinking they'd done the right thing, but in fact lost money from that. I want to talk, in line with the theme of exciting life, boring money. One of the most boring things we do that has the most impact is rebalancing. So as the share market's bounced around, when you look at the Aussie share market over the last year, you'll see, the cross hair there at the end of August, that price of about $91 for VAS. But if you go back through that line, it's crossed that price. It's been up, down, up, down, up, down. Now, while that's boring, looks like nothing's happening, there's been several times during that period where we, being the investment committee, have rebalanced some of the portfolios where we're selling a bit of Aussie shares when the market's up and often then buying them back when the market's down. So boring old rebalancing just makes a little bit of money, chips away here and there. And the same with the reserves portfolio. So when the markets are up, if you're sitting down with us and the markets are high, we'll often take a little bit of profit out of the markets and top up the reserves. But when they're low, we'll just wait to do that. So boring old rebalancing adds money. You can see here the Aussie share market, we're up for the year, but most of that is off the lows of last September. And for most of the year, from Christmas all the way through to where we are, we've just hovered sideways while producing a good dividend and long-term returns. Still in the good zone, about 8% over the last 10 years. US shares, are up for the year. Part of that's exchange rate drop as well, which is always good for US shares. And you look at the value of $10,000 invested 10 years ago, worth about nearly $60,000 for investment in US shares. About 30% of that return has come from the Aussie dollar dropping, but the rest is US shares. And when you look at the top 10 holdings there again, we get to enjoy the ownership of that magnificent seven I've been talking about, with the high-tech companies like Apple, Microsoft, Google, etc. All sit there in that portfolio, which makes part of your core portfolios. So global leaders, which is the top 100 companies in the world, once again dominated by those big techs, although you'll also note companies like Procter & Gamble, JP Morgan and Chase, Johnson & Johnson and ExxonMobil in there. And you'll also note, as I mentioned last month, NVIDIA, who makes chips for supercomputers, which are at the forefront of AI. Spectacular year for them. And you'll see the 1 year return there for global leaders, about 25%. So a really good year for that. And once again, this just reinforces the need for diversification. We'll have some things that are really good 1 year, not so good the next year, and vice versa. And great returns over the long run there. US small caps, about 11% for the year, so similar to the Aussie market. It's always interesting, the top 10 in US small caps are names we've never heard of. And there's well over 1,000 companies that make up this portfolio, and spectacular returns in the long run. So the index here and the benchmark here, $10,000 invested 10 years ago, with earnings reinvested would be worth $50,000. So great long-term returns. 12%, at a 12%, your money's going to double every 6 years. But a quiet month in the last month. Emerging markets are still the sleepy story. This year's been better. We're at 7%, but you'll see the 5-year average on emerging markets, 2%. That will come back. Traditionally, emerging markets go really well in the long run, but they can have long periods of more volatility, which is why they only make up a relatively small part of the portfolio, but important. And gold's had a cracker of a year, up 20%. So probably the best performer in the portfolio. And that's partly because it's been a volatile year, and partly because gold is a hedge against inflation. If inflation remains steady, people are attracted to gold, and particularly as some of the bigger countries in the world have a lot of debt, and that often leads to currency devaluations. Gold is seen as a hedge against that as well. So still an important part of the portfolio. Property market continues to ease up. I'll go through some stats in a minute, but there was a pretty cool stat from CoreLogic in their monthly report this month that showed how big the Australian property market is. And you look at the residential, so that's all our houses, worth 9.9 trillion. There's 11 million dwellings. And obviously this is where population growth is so critical. If we're going to add another million people, we're going to need, who knows, but let's call it 600,000 dwellings. And that's causing some of the property squeeze at the moment. You look at how much is in super in Australia, it's about 3.5 trillion, and you look at how much is in the Australian stock market, it's about 2.9 trillion. So they both fade. They're much smaller amounts than what is in residential real estate, and even commercial real estate, which you think about as the big end of town, is 1.3 trillion, far, far less than residential real estate. So for the Australian economy, such an important sector. And you can see one of the stats there that 56% of most Australians' household wealth is held in real estate. And yeah, interesting numbers. In terms of the year-on-year change, with the exception of Melbourne, everything is up the 2 to 6% range, 6% in Perth, 2 to 3% in most of the rest, and Melbourne down about 1%. But is all those states are up over the last quarter, around that 2 to 3%. But we did experience a bit of a dip back about a year ago now, but still fairly steady, still heading in the right direction. My observation, and everywhere around the country is different, but markets are turning over, but they're taking time to sell a house and settle is anywhere from 3 to 6 months, not 3 to 6 weeks like you'd see in a boom. But yeah, solid enough market that the crazy period of about a year ago has definitely gone, or about 18 months ago. Good article online. Let me go back to that. Australian population is growing by 2,000 people a day at the moment. Surge back of immigration. The chart down the bottom here shows what happened during COVID. Immigration dried up because of the border closures. So what we're seeing is really a catch-up. The numbers are forecast to come back down to the pre-COVID levels over the next year. But what it means is, there's about 1 million people coming into Australia in the next 18 months. Some of that's a return of all the students and others just getting back to normal. And you'll see in the last 12 months, we've added 563,200 people to the population, and they all need somewhere to live. So we're seeing this massive discussions about our housing crisis, which is real, rents going up. Now, make no mistake, in the long run, it will be solved. People will bring properties to market, whether they bring them quick enough. But at some stage, way down the track, there'll be a glut. But for now, there's a definite shortage, which is causing all sorts of challenges around the place. Not much change in the rate fronts. Rates are still hovering. Average 2-year fixed rate about 6.3%. And across the board, 1 year, 2 year, 3 year, 4 year, 5 year fixed rates are all in the sort of low sixes. And average variable rate about 6.6. As I said, you can get closer to 6 or just under, but that's the average that Aussies are paying. And all of that's been driven by the cash rate. You see, they started increasing the cash rate in 2022. We know there's an 18-month lag about the impact of that. So we really don't get to see the full impact of all those interest rate increases until pretty much most of 2024. And that's when we'll know whether we've gone too hard or gone too soft and how sticky inflation will be. But in the meantime, it's business as usual. Property clock, no changes in that at this stage. We're just waiting for the next month's data. So still a lot of the country kind of at the top of the cycle, but still opportunities for long-term investors. Yell out for anyone that wants some guidance there on either buying or selling with regard to where we are in the cycles. But once again, I'll remind us of our behavioral bias testing overconfidence. No matter how good a researcher is, and we really rate the researchers we use here, this is not a precision tool. Just because something is here doesn't mean it's not going to move, or it doesn't mean it's going to act exactly in that behavior, but it gives us the likelihood of making better decisions, and that's why we rely on research. So just to wrap up, once again, the theme: exciting life, boring money. The money has been a little bit boring of late, but as many of you have told me, boring's good. So all investing best done as part of a real plan, and that's with goals based on stuff that's meaningful to you. Portfolios designed to meet those goals, where we take a long-term view, and all that good little boring stuff: diversification, the right asset allocation, liquidity, low-cost index for most gross markets. And where we've fared from that, it's been for specific reasons, which worked brilliantly for us as interest rates went up. Protecting against short-term volatility through dollar cost averaging for our young clients who are building wealth, and the reserves portfolio for our retired clients. We rebalance regularly. That hidden superhero that probably adds 0.5% a year to portfolios, rebalancing And just a reminder, those 3 ways to lose money: panic and sell, have to sell, and not properly diversified. Happy as always to say our clients don't do any of those, which is why they have great results in the long run. Thank you for listening. I hope everything's going well in your world. And as always, look forward to catching up at some stage. And Rob McGregor signing off.